If you own silver right now, or you're thinking about buying some, there's a good chance you've already made a mistake. Not because silver is bad, but because the story you've been told about silver is incomplete. And incomplete stories, especially when it comes to your money, can be more dangerous than outright lies. Here's the thing. Silver looks simple. It's a shiny metal. You can hold it in your hand. You can put it in a safe. When the economy gets shaky, people start talking about precious metals, and silver always comes up as the affordable option. Gold is expensive, they say. Silver is the everyday person's hedge. It sounds reasonable. It sounds smart. It sounds like common sense. And that's exactly the problem. When something sounds too simple in the world of finance, you need to slow down. You need to ask harder questions. Because the simplicity of silver is not a feature. It's a trap that has caught millions of well-meaning people who thought they were being responsible with their money. Let me ask you something. Why did you first become interested in silver? Think about it for a moment. Was it because you read a deep analytical report on industrial metal demand? Was it because you studied the historical price charts going back decades and identified a compelling pattern? Or was it because someone told you, maybe in a video just like this one, that silver was a safe haven? That it would protect you when the dollar collapsed? That it was real money, unlike the paper currency in your wallet? If it was that last reason, you're not alone. That's how most people find their way to silver, through fear, through a narrative that positions silver as the antidote to an unstable financial system. And narratives are powerful. They stick in your brain. They feel true even when they're only partially true. The problem is that silver doesn't care about your narrative. Silver doesn't know that you bought it to protect your family. Silver doesn't understand that you're trying to hedge against inflation. Silver is just a commodity. It moves based on forces that have nothing to do with why you bought it. And when there's a mismatch between why you own something and how that thing actually behaves, you're setting yourself up for disappointment, or worse. Now, I want to be clear about something. This is not a video telling you that silver is worthless. That would be ridiculous. Silver has real uses. It has real value. Industries depend on it. Humans have treasured it for thousands of years. But acknowledging that silver has value is very different from understanding how silver actually works as an investment. And most people never make that distinction. They buy silver because it feels right, because it feels tangible, because holding a silver coin in your hand gives you a sense of security that looking at numbers on a screen never could. That feeling is real. But feelings and financial outcomes are two different things. And confusing them is one of the most common mistakes people make. Think about this. When someone buys a stock, they usually have some idea of what they're hoping for. They want the company to grow. They want earnings to increase. They want the share price to rise over time. There's a logic to it, even if the outcome is uncertain. But when someone buys silver, what exactly are they hoping for? Are they hoping for industrial demand to surge? Are they hoping for a currency crisis? Are they hoping for inflation to spike? Most silver buyers, if they're being honest, couldn't give you a clear answer. They just know that silver is supposed to go up when things go bad. But what does things going bad actually mean? And does silver really respond the way people think it does? This is where the cracks start to show. This is where the simple story begins to fall apart. Because when you look closely at how silver has actually behaved during periods of economic stress, the picture gets complicated. Sometimes silver does what people expect. Sometimes it does the exact opposite. And if you don't understand why, you're essentially gambling. You're hoping. And hope is not a strategy. The uncomfortable truth is that most silver buyers are operating on faith. Faith in a story they heard. Faith in a narrative that made sense at the time. Faith that the shiny metal in their safe will somehow rescue them when everything else falls apart. That faith might be rewarded, or it might not. But either way, it's not understanding. And without understanding, you're vulnerable. So if you've ever wondered why your silver hasn't performed the way you expected, or if you've ever felt a nagging doubt about whether you really know what you own, stay with me. Because what most people believe about silver and what's actually true are two very different things. Let's talk about what most silver buyers actually believe. Because these beliefs aren't crazy. They're not irrational. In fact, they make a lot of sense on the surface, and that's precisely why they're so sticky. That's why millions of people hold on to them even when the evidence starts pointing in a different direction. The first belief is that silver is real money. You've probably heard this phrase before. Gold and silver are real money. Everything else is just currency. It's a powerful idea with deep historical roots. For thousands of years, humans used silver as a medium of exchange. Empires rose and fell, but silver endured. It couldn't be printed by a central bank. It couldn't be created out of thin air. It had to be mined from the earth, refined, and minted. That scarcity gave it value. That tangibility made it trustworthy. And when you compare that to modern fiat currency, which can be created with a few keystrokes at the Federal Reserve, the contrast is striking. Paper money feels fragile, temporary, dependent on the whims of politicians and central bankers. Silver feels permanent, solid, beyond the reach of bureaucratic manipulation. This framing resonates with people, especially people who've watched the purchasing power of their dollars erode over time, especially people who remember 2008 and watched the financial system nearly collapse. If the banks can fail, if the currency can be debased, then maybe the only safe thing is something physical, something you can hold, something that doesn't depend on anyone else's promise. The second belief is that silver protects against inflation. This one seems almost self-evident. If the government prints more money, each dollar becomes worth less. Prices go up. But silver, being a finite physical resource, should hold its value. As the dollar weakens, silver should strengthen, its basic supply and demand. More dollars chasing the same amount of silver means higher silver prices. People look at charts showing the expansion of the money supply and they see a hockey stick. They look at government debt levels and they see numbers so large they're almost meaningless. And they conclude, reasonably, that this can't go on forever, that at some point the chickens will come home to roost, that inflation will surge and paper assets will suffer. And when that happens, silver will shine. The third belief is that silver is undervalued. This is a big one. Silver enthusiasts love to talk about the gold to silver ratio. Historically, this ratio has fluctuated, but there are periods when it was much lower than it is today, when gold was worth 15 or 20 times as much as silver, not 60 or 70 or 80 times. The argument goes that silver is currently cheap relative to gold, that it's being suppressed somehow, that when the market finally corrects this imbalance, silver will outperform dramatically. There are also arguments about industrial demand. Silver isn't just a precious metal, it's an industrial metal. It's used in electronics, in solar panels, in medical devices, in countless applications. As technology advances and green energy expands, the demand for silver should increase. Meanwhile, mine production is limited. New silver deposits are harder to find and more expensive to develop. This supply-demand dynamic, the argument goes, points to higher prices ahead. Now, here's the thing. None of these beliefs are stupid. They're all based on real observations. Silver really has been used as money throughout history. Inflation really does erode purchasing power. The gold to silver ratio really has been lower in the past. Industrial demand for silver really is growing. The logic chain is coherent. If you accept the premises, the conclusions follow naturally. And that's why these beliefs are so compelling. They don't require you to believe anything outlandish. They just require you to connect dots that seem obvious. But coherent logic isn't the same as accurate prediction. A story can make perfect sense and still be wrong. A narrative can feel true and still lead you astray. Because markets don't care about narratives. Markets are complex systems driven by countless factors, many of which are invisible to the average investor. And when your investment thesis is based primarily on a story, you're vulnerable to all the ways that story can fail to match reality. Think about it this way. Every investment thesis is essentially a prediction about the future. When you buy silver based on these beliefs, you're predicting that inflation will behave in a certain way, that industrial demand will grow at a certain rate, that the relationship between gold and silver will normalize, that the financial system will experience stress that drives people toward hard assets. These are big predictions, and they might be right, but they also might be wrong. Or they might be right in the long run, but wrong in the time frame that matters to you. And that's a distinction most silver buyers don't think about carefully enough. Because here's what nobody tells you when you're first getting excited about silver. The market can stay irrational longer than you can stay solvent. You can be right about the big picture and still lose money. You can have the correct thesis and still watch your investment go nowhere for years, even decades. Silver buyers often talk about patience. They say things like, "I'm not worried about the short term. I'm holding for the long haul." And that sounds wise. It sounds disciplined. But it also raises a question that most people avoid. How long is the long haul? 5 years? 10 years? 20? And what happens to your financial situation in the meantime? What opportunities do you miss while your capital sits in a metal that isn't moving? These are uncomfortable questions. Questions that don't fit neatly into the simple narrative. Questions that most silver content creators never ask, because asking them would complicate the story. And complicated stories don't sell as well as simple ones. But you deserve to hear the complicated version. You deserve to understand what you're really dealing with. Because there's something about silver that most buyers overlook completely. A quiet risk hiding in plain sight. Here's what almost nobody talks about when it comes to silver. The quiet risk, the one that doesn't show up in the promotional videos or the enthusiastic forum posts, the one that only becomes visible when you have been holding silver for a while and you start to notice something doesn't feel right. Silver is volatile, and not volatile in the way that stocks are volatile. Silver moves with a kind of violence that can catch even experienced investors off guard. It can surge 20 or 30% in a matter of weeks, and then it can give all of that back just as quickly, sometimes faster. Now, volatility isn't inherently bad. If you buy something and it goes up dramatically, you're not going to complain about volatility. But here's the catch. Volatility works both ways. And for most silver buyers, the timing doesn't work out the way they imagine. Think about when people typically buy silver. They don't buy when silver is quiet and boring and nobody's talking about it. They buy when silver is in the news, when prices are rising, and when there's excitement in the air, when someone on the internet tells them that this is finally the moment they've been waiting for. In other words, they buy after silver has already moved up. And then, more often than not, they watch it fall back down. This pattern repeats over and over again. Retail silver buyers are notoriously bad at timing, not because they're stupid, but because they're human. They respond to narratives. They get excited when everyone else is excited. They buy when it feels safe to buy, which is usually exactly when it's not. But volatility isn't even the biggest quiet risk. There's something else, something more insidious because it's almost invisible. Silver doesn't produce anything. When you own a stock, you own a piece of a company. That company has employees who show up to work every day. It has products or services that generate revenue. It has profits that can be reinvested or distributed to shareholders. Even if the stock price goes nowhere for a decade, you might still receive dividends. The company is doing something, creating something, growing something. When you own a bond, you're lending money to someone, a government, a corporation, and they pay you interest for the privilege of using your capital. You receive cash flow, regular payments, something tangible in return for your investment. When you own real estate, you can rent it out. You can collect monthly checks from tenants. The property might appreciate, or it might not. But in the meantime, it's producing income. It's working for you. Silver just sits there. It doesn't grow. It doesn't generate cash flow. It doesn't pay you anything for holding it. In fact, it costs you money to hold it. If you store it at home, you need a safe. You need insurance. You need to worry about theft. If you store it in a vault, you pay storage fees. Year after year after year. Those fees add up. They eat into whatever returns you might eventually realize. This might seem like a minor point, but over long periods of time, it becomes enormous because of something called opportunity cost. Every dollar you put into silver is a dollar you didn't put somewhere else, somewhere that might have been generating returns, somewhere that might have been compounding, and compounding is the most powerful force in investing. It's what turns modest sums into fortunes over decades. But compounding requires growth. It requires reinvestment. It requires your money to be doing something, not just existing. When silver goes nowhere for 10 years, which has happened multiple times throughout history, you haven't just failed to make money, you've lost the money you could have made if that capital had been deployed differently. And that loss doesn't show up on any statement. You never see it. You just experience it as a vague sense of falling behind, as watching other people's portfolios grow while yours stays flat. There's another quiet risk that almost nobody mentions: liquidity, or more precisely, the illusion of liquidity. Yes, silver is liquid in the sense that you can always find a buyer. It's not like owning a piece of obscure art or a collectible that might take months to sell. But there's a difference between being able to sell something and being able to sell it at a fair price. When you buy physical silver, you pay a premium over the spot price. This premium covers the dealer's costs and profit margin. It varies depending on what form of silver you're buying. Coins carry higher premiums than bars. Certain coins carry higher premiums than others. You might pay 5, 10, even 20% above the spot price, depending on what you're purchasing. And here's the part that stings. When you go to sell, you don't get that premium back. In fact, you often sell below the spot price. The dealer needs to make money on both ends of the transaction, so you're hit coming and going. This spread between buying and selling prices is a hidden tax on silver ownership, and it means that silver needs to move significantly in your favor just for you to break even. If you paid a 10% premium to buy and you lose 5% when you sell, silver needs to rise at least 15% before you see any profit at all. And that's before accounting for storage costs, insurance, and the opportunity cost of your capital. Most silver buyers don't think about this when they're making their purchase. They see the spot price moving up, and they imagine their holdings increasing in value by the same percentage. But the math doesn't work that way in the real world. The math is harder, the math is less forgiving, and then there's the psychological toll, the burden of watching and waiting. Silver buyers often talk about patience as a virtue, and it is in many contexts. But there's a difference between patience and paralysis. There's a difference between holding through temporary volatility and holding through years of stagnation because you've become emotionally attached to a narrative. When you've been telling yourself for years that silver is about to break out, that the manipulation is about to end, that the system is about to crack, it becomes very hard to change your mind. You've invested not just money, but identity. You've told friends and family about your silver position. You've argued with skeptics. You've built a mental framework that depends on silver eventually proving you right. And that emotional investment can trap you. It can keep you holding long past the point where a more detached investor would have reassessed. It can keep you adding to a position that is not working, because admitting it is not working would mean admitting you were wrong, and nobody likes to admit they were wrong. This is the quiet risk that nobody warns you about. Not the risk that silver will crash, not the risk that your coins will be stolen, but the risk that silver will slowly, silently consume your capital, your time, and your attention while the world moves on without you. So where does all of this leave you? If you own silver, or if you've been thinking about buying some, what are you supposed to do with everything we've just discussed? I want to be careful here, because I'm not in the business of telling you what to do with your money. That's not my place. I don't know your situation. I don't know your goals. I don't know your risk tolerance or your time horizon or the 100 other factors that should inform your financial decisions. Anyone who tells you exactly what to do without knowing those things is not being honest with you. But what I can do is leave you with some observations, some things to consider, some questions that might be worth sitting with, even if the answers are uncomfortable. The first observation is this: silver is not what most people think it is. It's not a simple hedge. It's not a guaranteed protection against anything. It's a complex, volatile, non-productive asset that behaves in ways that often contradict the narratives surrounding it. That doesn't make it worthless, but it does mean that buying silver based on a story you heard without understanding the full picture is a risk most people don't recognize until it's too late. The second observation is that simplicity can be seductive. In a world that feels increasingly chaotic and complicated, there's something deeply appealing about an investment that seems straightforward. Buy metal, hold metal, wait for the system to break, profit. It's a clean narrative, it fits on a bumper sticker, and that simplicity is part of what draws people in. But the financial world doesn't reward simplicity. It rewards understanding. It rewards nuance. It rewards the willingness to question your own assumptions and update your views when the evidence demands it. The people who do well over the long term are not the ones who found the one simple trick. They're the ones who did the hard work of truly understanding what they own and why they own it. The third observation is that narratives are powerful, but they're not predictions. The story about silver as real money, as an inflation hedge, as an undervalued asset waiting to explode, that story has been around for decades. And it's been wrong more often than it's been right. Not completely wrong. Silver has had its moments. But the timing and magnitude of those moments rarely matched what the narrative promised. People who bought silver in 2011 at the peak of the last major rally are still underwater today. More than a decade later, they had the narrative, they believed the story, and they've spent years watching their investment languish while other assets climbed. That's not a failure of patience, that's a failure of understanding. A failure to recognize that being right about the general direction is not enough if you're wrong about everything else. The fourth observation is that opportunity cost is real, even when it's invisible. Every year your capital sits in an asset that isn't growing, you're falling behind. Not in absolute terms, necessarily. Your silver might hold its value. But in relative terms, compared to what that capital could have done elsewhere, you're losing ground. And those losses compound just like gains do. They accumulate quietly, invisibly, until one day you look up and realize how much ground you've lost. This doesn't mean you should never own silver. There might be a place for it in a diversified portfolio. A small allocation that serves a specific purpose. But that's very different from making silver a cornerstone of your financial strategy. Very different from betting your future on a metal because someone told you it was safe. The fifth observation is perhaps the most important. You are responsible for your own financial education. Not the people who sell silver. Not the people who make videos about silver. Not the people who write articles or run forums or post on social media. You. Because at the end of the day, it's your money, your future, your family's security. And no one will ever care about those things as much as you do. The silver industry, like every industry, has people whose incentives are not aligned with yours. Dealers make money when you buy, regardless of whether the investment works out for you. Content creators get views when they tell exciting stories about silver going to the moon, regardless of whether those stories come true. Commentators build audiences by confirming what people already want to believe, regardless of whether those beliefs are accurate. This doesn't make them bad people. They're just operating within a system that rewards certain behaviors. And understanding that system, understanding the incentives at play, is part of your job as someone trying to navigate the financial world. So question everything. Including this video, I've presented a perspective today, a set of observations and concerns about silver that I think are important. But I could be wrong. I could be missing something. I could have biases I'm not even aware of. Your job is not to accept what I've said uncritically. Your job is to take this information, combine it with other information, think critically, and reach your own conclusions. That's harder than just being told what to do. It's less satisfying than finding someone who will give you a simple answer. But it's the only approach that actually works over the long term. The only approach that puts you in control of your own financial destiny. Silver looks simple. That's why it appeals to so many people. But that simplicity is a mirage. Behind it lies a web of complexity, volatility, hidden costs, and misaligned incentives that most buyers never see until they've already been caught. I'm not telling you to sell your silver. I'm not telling you to avoid it forever. I'm telling you to understand it. Really understand it. Not the story, not the narrative, not the promise, the reality. Because only when you understand the reality can you make decisions that actually serve your interests. And that's what I try to do here. Cut through the noise, ask the uncomfortable questions, explore the nuances that most people skip over. If that sounds valuable to you, if you want more content that challenges assumptions and pushes for deeper understanding, consider subscribing. Not because I have all the answers, but because asking better questions is the first step toward finding them. The tension around silver isn't going to resolve itself anytime soon. The debates will continue. The narratives will persist. The volatility will remain. What you do with that reality is up to you.